Hey everyone, welcome back to the channel. Before we start, quick disclaimer as always. This video is for educational and informational purposes only. It's not financial advice. I'm not your financial advisor. I'm just here to share perspective, experience, and hopefully help you think more clearly about investing. Now, I want to start with a simple question. Have you ever felt like the investing world is forcing you to pick a side? Either you're a growth investor, chasing total return, ignoring income. Or you're an income investor, focusing on yield, sacrificing growth. Or maybe you're a dividend investor, somewhere in between, but still never fully satisfied. I've worked with hundreds of American investors over the years, retirees, professionals, business owners, young investors just getting started, and I can tell you this with complete honesty. Most people don't fail because they choose the wrong stocks. They fail because their strategy doesn't match how real life actually works. Markets go down, emotions kick in, people panic, they sell at the worst time, or they freeze and do nothing. And that brings me to today's video, because today I want to talk about an ETF that, in my opinion, breaks the traditional rules of investing and does it in a way that actually makes sense for real people, not textbook investors. The ETF is called HDIV, the Hamilton Enhanced Canadian Covered Call ETF. And yes, I know what you're thinking already. Another covered call ETF. High yield means no growth. This must be too good to be true. I get it. I was skeptical too. But after analyzing this fund deeply, not just the yield, not just the chart, but the structure, the strategy, the behavior during different market environments, I genuinely believe HDIV might be one of the most intelligently designed ETFs I've seen come out of Canada. Maybe even the greatest Canadian ETF ever created. And I know that's a bold statement. So in this video, I'm not asking you to believe me. I'm going to walk you through the reasoning step by step, like I would with a client sitting across the table from me. Here's the key idea I want you to keep in mind as we go through this. HDIV is not trying to win one game. It's designed to survive all of them. Bull markets, sideways markets, drawdown phases, retirement income years. Let me ask you another question. Have you ever noticed how most growth-only portfolios fall apart emotionally the moment you actually need the money? On paper, index funds look perfect. In real life, when markets drop 30% and you need to sell units to pay bills, suddenly that long-term mindset becomes very hard to maintain. That's the drawdown problem, and almost no one talks about it until it's too late. HDIV approaches this problem differently. Instead of forcing you to choose between growth or income, it blends multiple strategies into one structure. You have growth-oriented components, you have covered call income, you have dividend-paying blue-chip companies, you even have advanced option strategies like zero DTE exposure. Not because it sounds fancy, but because no single strategy works all the time. From a professional standpoint, that's what immediately caught my attention. Most ETFs are one-dimensional. HDIV is multidimensional. And here's something most people miss. When investors look at ETFs, they obsess over price charts. But price is not performance. Performance is total return, price appreciation plus distributions. And once you look at HDIV through that lens, something very interesting happens. It starts outperforming, not just income ETFs, but broad market ETFs, even some pure growth portfolios. That's when the conversation changes. Because now the question isn't, why does this ETF pay such a high yield? The real question becomes, how is this ETF delivering high income while still competing, and in some cases beating, traditional growth strategies on total return? That's what we're going to unpack in this video. We'll briefly go through how HDIV evolved over time. We'll talk about what's actually inside the fund, because that matters. And then I'll walk you through the core reasons why, from a professional standpoint, this ETF deserves serious attention. Not hype, not blind optimism, just logic, structure, and results. Whether you're a growth investor, an income investor, or someone thinking about the future drawdown phase of your portfolio, I think this discussion will challenge how you think about ETFs. So grab a coffee, slow down for a moment, and let's talk about HDIV, not as a ticker symbol, but as a solution to real-world investing problems. Let's get into it. All right, so now that we've set the stage, let's actually talk about why HDIV is different. And I want to start here because this is the foundation of everything. HDIV is not a single strategy ETF. It's a portfolio of strategies, intentionally blended together. From a professional perspective, that's a huge deal. Most ETFs are built around one idea: give me growth, or give me income, or give me dividends. HDIV doesn't do that. Instead, it asks a more intelligent question: what does an investor actually need across different phases of life and different market conditions? That's why inside HDIV, you don't just find covered calls. You also find pure growth components, dividend-focused holdings, and even advanced option strategies. Let me explain why that matters. In my years working with American investors, I've seen this pattern over and over again. People start out as growth investors. Markets are rising, everything feels easy. Then life happens. Kids, business downturns, retirement, unexpected expenses. Suddenly, the conversation changes from how fast can this grow to how do I generate cash without destroying my portfolio. That transition is where most portfolios break. HDIV is designed not to break at that moment, because inside the fund, you already have a balance. You have growth-oriented ETFs like HFIN and HUTS, which don't sell covered calls and maintain full upside exposure. These are there for long-term capital appreciation. At the same time, you have income-focused ETFs like HMAX and UMAX, which use covered calls to generate consistent monthly cash flow. And here's the key: they don't compete with each other, they stabilize each other. Growth fuels long-term performance, income smooths volatility and creates psychological comfort. That combination alone puts HDIV in a very small category of ETFs. But it goes deeper. HDIV doesn't just diversify by asset class or sector, it diversifies by strategy. This is something most retail investors underestimate. Inside HDIV, you have traditional covered call strategies, partial covered call exposure, pure growth exposure, and even zero DTE option strategies through funds like mste and QDIM. Why is that important? Because no single option strategy performs best in every market environment. Zero DTE strategies thrive in high volatility, short-term conditions. Traditional covered calls shine in sideways markets. Pure growth benefits from strong bull markets. By combining all of them, HDIV doesn't need to predict the future. It just needs markets to keep existing. That's professional portfolio design. Now let's talk about something controversial: leverage. Yes, HDIV uses about 25% leverage. And I know exactly what some of you are thinking. Leverage equals risk. That's only partially true. What matters is how much leverage, who controls it, and what it's paired with. This is not you borrowing on margin. This is institutional leverage, managed by a firm with billions under management, at borrowing costs individual investors could never access. And importantly, this leverage is paired with covered call strategies, which naturally reduce volatility. So while leverage increases exposure, covered calls reduce price swings. From a risk-adjusted perspective, those forces largely offset each other. That's why, historically, HDIV's volatility has been comparable to broad market ETFs, despite generating significantly higher income. Now let's talk about income, because this is where HDIV really changes the conversation. HDIV currently pays over 10% annually, distributed monthly. But here's what matters more than the number. Those distributions have never been cut, only increased. That's rare, especially in a world where many high-yield products sacrifice NAV to maintain payouts. Which brings us to taxes. For Canadian investors especially, HDIV is extremely tax efficient. A large portion of its distributions come from capital gains and return of capital, not ordinary income. That means less tax drag, more money staying invested, better after-tax returns. Even from a US-based professional perspective, this structure is elegant. And finally, we have to talk about performance. Because at the end of the day, theory doesn't matter if results don't show up. When you look at total return, not just price, not just yield, HDIV has outperformed. Broad Canadian market ETFs, global index funds, even the S&P 500 over certain periods. And that's not marketing spin. That's math, which leads me to this point, and I'll say it very clearly. Growth is not price appreciation. Growth is how much your money grows over time, including cash flows. Once you understand that, the argument against HDIV becomes very weak, because HDIV isn't trying to impress you with a flashy chart. It's trying to help you stay invested, stay disciplined, and stay solvent across decades. And that, in my experience, is how real wealth is built. Now, with all of that said, we still need to answer the big question. Does this actually make HDIV one of the best ETFs ever created in Canada? That's exactly what we're going to address in the final section, where I'll tie everything together and talk about who this ETF is truly for and who it isn't. Let's wrap this up. So after everything we've covered in this video, let me bring this home in a very simple, honest way. HDIV is not a miracle ETF. It's not magic. And it's definitely not perfect. But in my professional opinion, it's one of the most realistically designed ETFs I've seen for how people actually invest in the real world. Because the truth is this: most investors don't fail because markets are unpredictable. They fail because their portfolios are fragile. They're built for one environment, one strategy, one version of the future. And when the market changes, or life changes, the portfolio no longer fits. HDIV takes a different approach. It doesn't try to guess what the next bull market will look like. It doesn't assume rates will always go down or stocks will always go up. Instead, it builds in flexibility. Growth when markets run, income when markets stall, cash flow when investors need stability, and diversification, not just across sectors, but across strategies. That's why I keep coming back to this idea. HDIV is not about maximizing returns in the best year. It's about surviving and compounding over all years. Now let's be very clear about who this ETF is for. If you're someone who loves trading, timing the market, chasing the hottest stock of the month, this probably isn't for you. If you believe income is irrelevant and dividends don't matter, this might not resonate. But if you're an investor who values consistent cash flow, strong total return, emotional stability during drawdowns, and a portfolio that works with human behavior, not against it, then HDIV deserves a serious look, especially if you're approaching or already in the drawdown phase of life, where selling units in a down market is no longer an academic discussion, but a real financial decision. And here's something I want you to think about before you leave this video. What if the best investment strategy isn't choosing between growth and income, but combining them intelligently? What if real wealth isn't built by swinging for home runs, but by staying in the game long enough for compounding to do its job? That's the philosophy behind HDIV. And whether you decide to invest in it or not, I hope this video challenges one dangerous myth: that investing has to be extreme. All growth or all income. All risk or no risk. In reality, the strongest portfolios live in the middle, balanced, adaptive, and boring enough to last. So let me ask you this. Do you think HDIV deserves the title of the greatest Canadian ETF ever created? Or is there another ETF you believe does this job better? I'd genuinely love to hear your thoughts. Drop them in the comments below. If you learned something from this video, give it a thumbs up. And if you want more honest, real-world investing conversations like this, make sure to subscribe. As always, stay patient, stay disciplined, and remember, the goal isn't to beat the market this year. The goal is to win over a lifetime. Thanks for watching, and I'll see you in the next one.